Ever wondered how the ultra-rich manage to accumulate and maintain their wealth, seemingly untouched by taxes, lawsuits, or economic downturns? It's not always about luck or inheritance. Often it's about a carefully constructed system, a blueprint designed to shield their assets from prying eyes and grasping hands. This isn't just about stashing money in a mattress. It's a sophisticated strategy involving international law, corporate structures, and a deep understanding of financial loopholes. So, let's pull back the curtain and expose the basic blueprint used by the ultra-rich to protect their fortunes. We're going to break down the key steps, revealing the methods they employ to create layers of separation between themselves and their assets. This is the architecture of wealth preservation, and it's more accessible than you might think, though it certainly helps to have the resources to implement it effectively. Step 1. Set up a shell company. This is the cornerstone of the entire operation. A shell company, at its most basic, is a corporation that exists on paper but has no significant assets or active business operations. It's a legal entity, but its primary purpose is to act as a holding company, a vessel for assets, or a conduit for financial transactions. The beauty, or perhaps the ugliness, depending on your perspective, lies in its simplicity and the anonymity it provides. Setting up a shell company is surprisingly easy, often requiring little more than a registered agent and some paperwork. But the implications are far-reaching. It's the first step in creating a wall between your personal wealth and potential liabilities. The location is key. Start with a paper company in the Caymans, BVI, or another tax haven. These jurisdictions are known for their favorable tax laws, strict privacy regulations, and minimal reporting requirements. They offer a level of secrecy that's hard to find elsewhere, making them ideal for establishing shell companies. Think of it as setting up a virtual headquarters in a place where the rules are designed to benefit the wealthy. These aren't just vacation destinations, they're financial fortresses, carefully crafted to protect assets from taxes, creditors, and legal challenges. The allure of these tax havens is undeniable, offering a sanctuary for wealth that's difficult to penetrate. It doesn't need an office or employees, just a name on a filing cabinet. In fact, many of these shell companies exist solely on paper, with no physical presence or staff. They're essentially legal fictions, created for the sole purpose of holding assets and conducting financial transactions. The address might be a mailbox in a law firm or a shared office space with dozens of other shell companies. The key is that it provides a legal address and a semblance of legitimacy, without the overhead of a real business operation. This lack of physical presence is what makes them so difficult to trace and regulate, adding another layer of protection for the ultra-rich. Step 2. Let that company own everything. This is where the magic happens. Once the shell company is established, the next step is to transfer ownership of your assets to it. This includes everything from real estate and investments to intellectual property and personal belongings. The goal is to remove your name from the ownership equation, creating a buffer between you and your wealth. This transfer can be done through a variety of legal mechanisms, such as deeds, bills of sale, and assignment agreements. The result is that the shell company becomes the legal owner of your assets, while you retain control and benefit from them indirectly. Instead of owning your mansion, the company does. The sprawling estate, the luxurious furnishings, the meticulously landscaped gardens, all of it is owned by the shell company. You still live there, you still enjoy it, but on paper, it's not yours. This simple shift in ownership has profound implications for tax liability, asset protection, and estate planning. It shields the property from potential lawsuits, creditors, and even divorce proceedings. The mansion becomes an asset of the company, not a personal possession, making it much harder to reach. Instead of opening a bank account, the company does. All financial transactions are conducted through the company's account, further obscuring your personal involvement. Income is deposited into the company's account, and expenses are paid from it. This creates a clear separation between your personal finances and your business activities, making it more difficult to track your wealth and assess your tax obligations. The company becomes the financial hub, managing all income and expenses related to your assets. You don't own anything on paper, so there's nothing to tax, sue, or seize. This is the ultimate goal of the blueprint, to create a situation where you control and benefit from your assets, without actually owning them. This makes it incredibly difficult for anyone to claim your wealth, whether it's the tax authorities, creditors, or disgruntled litigants. The layers of separation created by the shell company and the trust make it virtually impossible to penetrate the structure and reach your personal assets. It's a legal fortress designed to withstand even the most aggressive attacks. Step 3. Use a trust to seal it off. To further enhance the protection, the shell company is placed into a trust. A trust is a legal arrangement where a trustee holds assets for the benefit of a beneficiary. In this case, the trust owns the shell company, which in turn owns your assets. This adds another layer of separation and complexity, making it even more difficult to trace the ownership back to you. The trust acts as a shield, protecting the shell company and its assets from potential threats. Now put the company into a trust in a different jurisdiction. Just as with the shell company, the location of the trust is crucial. Certain jurisdictions, such as the Cook Islands or Nevis, have very strong trust laws that protect assets from creditors and lawsuits. These jurisdictions are known for their asset protection trusts, which are specifically designed to shield wealth from legal challenges. By placing the shell company into a trust in one of these jurisdictions, you create an almost impenetrable barrier around your assets. You're not the owner, just the beneficiary. As the beneficiary of the trust, you have the right to benefit from the assets held within it, but you don't own them directly. This is a subtle but crucial distinction. It means that you can enjoy the fruits of your wealth without being legally responsible for it. You can receive income from the trust, use the assets held within it, and even direct the trustee on how to manage them. But because you're not the owner, your assets are protected from creditors and lawsuits. You use the yacht. The yacht is owned by the shell company, which is owned by the trust. But you get to sail the high seas, enjoying the luxury and freedom it provides. You're not the owner on paper, but you have full access and control. You live in the villa. The villa is owned by the shell company, which is owned by the trust. But you get to wake up every morning to breathtaking views, swim in the infinity pool, and enjoy the privacy and tranquility it offers. You're not the owner on paper, but you have the exclusive right to reside there. But legally, you own nothing. And that's the point. By strategically utilizing shell companies and trusts in favorable jurisdictions, the ultra-rich can effectively shield their wealth from taxes, lawsuits, and other potential threats. It's a complex and sophisticated system, but it's also a highly effective one. While this blueprint may seem out of reach for the average person, understanding its principles can provide valuable insights into the world of wealth preservation. We've explored how the ultra-rich accumulate vast fortunes, often shielded from the traditional tax systems. But a crucial question remains: how do they actually this money? How do they translate these abstract figures on offshore accounts into tangible benefits and lavish lifestyles? It's not as simple as transferring millions into a checking account. The strategies they employ are far more intricate and frankly quite clever. But how do they spend the money? The key lies in understanding that the goal isn't necessarily to bring the money on shore. In fact, that's precisely what they want to avoid. If everything's offshore and not in your name, held within complex webs of shell corporations and trusts, how do the rich spend any of it? It seems like a paradox, doesn't it? Having all this wealth, yet seemingly unable to directly access it. The answer is surprisingly simple, yet profoundly impactful. They don't transfer the money to their personal accounts. Imagine the red flags that would raise. The tax implications alone would be astronomical. Direct transfers would defeat the entire purpose of sheltering the wealth offshore in the first place. So, what's the alternative? Instead, they borrow against it. This is where the magic happens. Think of your offshore assets as collateral, a guarantee. They approach a bank, often one complicit in these very schemes, and secure a loan. The offshore funds remain untouched, continuing to grow, while the loan provides immediate access to capital. This isn't just a theoretical concept for individuals. Even massive corporations utilize this strategy. When Apple, for instance, wanted to use its offshore cash in the US, they faced a similar dilemma. How could they access those funds without triggering a massive tax bill? The answer, predictably, wasn't to repatriate it and pay taxes. That would have been far too costly. Instead, they sought a more creative solution, a solution that allowed them to tap into the value of their offshore holdings without actually bringing the money home. They used it as collateral for loans. Just like the individual avoiding taxes on a smaller scale, Apple leveraged its offshore wealth to secure financing for its operations within the United States. This is a common practice, a well-worn path for those with the resources to navigate the complexities of international finance. The wealthy do the same thing. They understand that owning assets offshore isn't about bringing the money back. It's about unlocking its potential without incurring tax liabilities. It's about playing a different game with different rules. Let's illustrate with a simple example. $10 million in offshore assets, sitting safely in a tax haven, growing steadily. Take out a $5 million loan at 2% interest. Suddenly, you have access to a significant sum of money without ever touching your offshore funds. The interest payments are often negligible compared to the tax savings and the potential growth of the untouched assets. Spend it tax-free. Buy that yacht, that mansion, that private jet. Indulge in the luxuries of life, all funded by borrowed money, secured by assets carefully shielded from taxation, because you never trigger a tax event. The money you're spending isn't technically income, it's a loan. And loans, of course, aren't subject to income tax. It's a loophole so large you could fly a 747 through it. Just borrow, spend, repeat. It's a self-perpetuating cycle of wealth accumulation and lavish spending, all while minimizing or even eliminating tax obligations. It's a system designed to benefit those already at the top, further widening the gap between the rich and the rest. Until the system collapses, or until regulations finally catch up. The question remains, how long can this continue? Welcome to the final stage of wealth preservation, die. It might sound morbid, but this strategy is a cornerstone of how the ultra-wealthy maintain their fortunes across generations. We're not just talking about avoiding estate taxes. We're diving into a sophisticated financial maneuver that leverages a unique aspect of tax law to ensure wealth continues to grow, even after you're gone. This isn't about loopholes or shady dealings. It's about understanding and utilizing the rules of the game to your advantage. This strategy even works after death, and it's surprisingly simple in concept. The key lies in something called the step-up in basis, a provision in the tax code that can dramatically reduce or even eliminate capital gains taxes on inherited assets. Imagine passing on a legacy of financial security, not just for your children, but for generations to come. This is the power of understanding and implementing this final stage. Thanks to something called the step-up in basis, when you die, the value of your assets resets for tax purposes. Let's say you bought a piece of art for $100,000, and over the years it appreciates to $1 million. Normally, if you sold it, you'd owe capital gains taxes on the $900,000 profit. However, if you hold on to it until you pass away, your heirs inherit it at the stepped-up value of $1 million. This means if they sell it for $1 million, they owe absolutely no capital gains tax. If your offshore company owns $50 million in assets, your heirs inherit the full value, completely shielded from capital gains taxes on the appreciation that occurred during your lifetime. This is a game changer for wealth transfer, allowing families to preserve their fortunes and avoid significant tax liabilities. It's about strategically positioning your assets to maximize their value for future generations. Paying no capital gains tax on past appreciation. This is a massive advantage, especially when dealing with assets that have significantly increased in value over time, such as real estate, stocks, or artwork. The step-up in basis effectively wipes the slate clean, providing a fresh start for your heirs and allowing them to build upon your legacy without the burden of hefty tax bills. Combine this with life insurance to pay off any debt. You pass down massive wealth, tax-free. Life insurance can provide liquidity to cover estate taxes or other expenses, ensuring that your heirs receive the full benefit of the stepped-up basis. It's a powerful combination that allows you to leave a lasting legacy of financial security and prosperity. It's a strategy called buy, borrow, die. This approach involves acquiring assets, borrowing against them to fund your lifestyle, and then passing them on to your heirs at a stepped-up basis, effectively eliminating capital gains taxes. It's a sophisticated strategy that requires careful planning and execution, but the rewards can be substantial. And it's how the world's richest stay rich, generation after generation. They understand the power of the step up in basis and use it to their advantage, ensuring that their wealth continues to grow and benefit their families for years to come. This isn't just about accumulating wealth. It's about preserving it and passing it on in the most tax-efficient way possible. It's a strategy that requires a long-term perspective and a deep understanding of the tax laws, but it's a key component of building and maintaining lasting wealth. While most people pay taxes on every paycheck, the wealthy use offshore systems to move through the world untaxed, invisible, and unstoppable. Because the real power isn't in how much you earn, it's in what you own and how you own it. Thanks for watching Capital Clarity. Hit like if this opened your eyes, and stick around, because next time, we're diving deep into the buy, borrow, die strategy. Stay sharp, stay curious, and as always, follow the money.